Right, welcome everyone. So glad to have you here this evening. This evening, we're going to be talking about how to scale up, how to become the next unicorn. Our guest speaker this evening is Christina Marinovich. She's based in London and she works with Duamentes. So her focus is in supporting innovation and growth with early stage ventures. She works between entrepreneurs and strategy and ecosystem building. So her goal is to be helping to build a more effective ecosystem, which is a lot what we're trying to do. And so we're a really good fit for supporting each other. And her specific emphasis is on helping startups refine your position and how to connect with investors and partners. And so that's partly what we do as well. We are working to build more investors and more partners for people. She works with, okay, I'm not allowing AI this. Sorry about that. She works with putting together the landscape and helping things come together. One of the things I really like about what she does is that she is focused on a relationship approach to her work, and but she has a lot of operational background that can help with that. All right, I was hoping she would be here by now. Um, if you have not had the opportunity to, and you're interested in joining our next funding round, I'm going to talk a bit about that. We've got today and tomorrow that you can still get into our round. I'll put the link in the chat. And this is, so we have a 12-week program. Our goal is to help everybody move forward with what you're doing. And all you need to do and to join our next round is to put something into Gust. It doesn't need to be a completed profile. And then I can meet with you if you like, and we can go over it. All right. Yay, Christina's here. I've already
Hey,
introduced you.
perfect. Okay, sorry for being late. The notebook,
Yeah,
the laptop decided to update in the worst time possible, but I'm so happy I finally made it here.
I am too. Go ahead and get going when you're ready.
Perfect.
And
Perfect.
well, okay, give me 1 minute. I'm going to put into the chat the link to our next funding round. Okay, take it away. Good timing.
Perfect. So I'll start sharing the presentation just now. Just give me a second with the technical aspect once again, and we'll just start. Um, okay, so I guess you should be seeing my screen right now, the presentation. Perfect.
Yes.
So at least it's working after the update. So, as Martha probably told you, I'm Christine Marinovich. I'm the Chief Operating Officer at Duamentes. We are a deep research and consultancy firm that basically helps as a delivery team for established enterprises and scale-up businesses to be more efficient in their activities. And today I will be covering topic of crafting a profitable business model for startups, building it from scratch if you're a very early stage project and you're just moving into structurizing your business and your product idea in general, and covering a few more specifics if you've already been down this path and how you can develop your business model further and how you can actually craft something that is more suitable for the investors in the current market. So we will start today with the fact what is a good business idea, how actually the investors are looking at business idea nowadays in the market. Obviously, a lot of investors are focusing now on IE, but it's not the only one aspect that they're looking for at the moment because they're still investing in other types of projects. So we're going to cover in what a good business idea is in terms of problem, solution, evaluation, description, how the investors are looking at the information, how they're accepting the propositions of the startup, and so forth. So then we cover a little bit more about the VC landscape today, and then we go through the business model and financial model in bigger details, and then we look at the template that we currently use and recommend using for startups. It's going to be a very heavy document. There are going to be a lot of files inside this model, but you can always adapt it to the needs that you currently have. So when we talk about a good business idea, these are types of the things that investors are looking for at the moment. And when I talk with investors that are in our network that we partner with, they usually look at the very specific things. First of all, they look at the problem that has been validated and has a very real point experienced by either a meaningful number of people, but in certain markets, or it has been challenged before, or it has been pronounced in a certain ways in research stage. So, for example, when you talk about a problem, there are two specific approaches how you can actually build a successful product. First is that you're providing the solution to existing problem that combines different types of solution that already exist on the market. And a lot of technical business solution that we use nowadays, like Slack, like Zoom, which we have our call in, and other companies, they actually built on the idea and technology that already existed, but they made the solution of the problem that existed before so good and so desirable that they have succeeded significantly more than other companies. Second thing, the second approach that we usually see, especially when we talk about success stories, are the disruptors. Basically, disruptors are the companies that decided to change the market as it is. And this is heavily what we see today in the markets, like IE roll-up strategies, when everything is IE adjacent, and a lot of industries on the whole are being transformed by a approach. Basically, it means that there has been a problem of inefficiency in some sense. It might be in B2C or B2B market. And approaching this from the standpoint of efficiency on the level of other digitalized or i.e. developed industry can create a new additional market value, market share to these companies already exist in the market. And a lot of startups approach this problem by doing what they have been doing in other markets and building the same business models that they have been successful in other markets in the traditional existing legacy ones, as we call it. So basically, the problem is something that has been experienced by a meaningful number of people and has been validated in numbers. And this is one of the biggest assets that you can have in your pitch deck and your business model in particular. So, solution is basically a comprehensive product or service that addresses this problem either better way. Again, the reference to Zoom, to Slack is very relevant here because other programs like this have existed before. I'm a corporate user of Teams, and you can imagine that it can be updated, it can be developed into something far more useful and user friendly than the version that exists nowadays, but still a lot of people use it. So there are always new things that can be added to the service that already exists, either in terms of solution that is just more user friendly in terms of design, or it's faster, or it's something that can be individually updated, which is sometimes very useful for B2C customers, or it's faster. Faster is usually one of the best terms of being competitively better than other companies, especially in B2B markets. And a lot of investors are looking at solutions that have been doing something faster than the solution that already existed or cheaper. Cheaper is very relative aspect of solution because it's usually far more connected to the time and to the market and to the competitors than any other reasons behind the solution, because you can be objectively faster, you can be objectively better, and there's certain metrics they can follow with your customers to understand that you actually provide a better solution. And they usually the ones that are actually very much connected to the financial model. And we're going to cover this later today. The cheaper aspect of the business is usually a little bit harder for competition, because if you just build in the cheapest version, there's always going to be a chance that there's going to be another competitor that's going to use some secret sauce, some unfair advantage to make even cheaper this decision and solution for the market. And if you only compete on terms of price, then it actually doesn't help you to build loyalty and create network effects that it will succeed, that will make your business succeed further. So solution either has to be better, faster, or cheaper, but usually we strive to have either better or faster solution for the problem that we already validated on a significant, meaningful number of people. And the last one, the business model. The last aspect has become far more comprehensive and far more important for investors nowadays, because there have been a lot of changes to the markets. In the last 5, 6 years, the venture capital and private equity companies, they have experienced a huge amount of shocks to the systems. First, there was COVID, then there has been changes in the economy due to different political and economical situations in the world. A lot of money has been lost to the crypto projects in the 21, 22, and 23 in particular. So there has been a lot of changes to how the investors receive money and how they choose to spend the money. And it's very important to understand how investors actually look at the money, where do they get them, in order to be able to talk with them about the business model in the numbers and the words that they consider effective and efficient to make a decision, an informed decision, and make a decision to invest finally. We are going to be talking about this in the second slide, covering what are the aspects of the investing you should know as aspiring entrepreneurs, aspiring startup founder, to make it easier for you to talk with the potential investors, especially the one from organizations such as VCs, funds that already work with the startups or family offices, or even the grant system if you choose to go down that road. So sustainable scaling is usually the final aspect of the business model. And when we talk about sustainable scaling, we in particular look at the ways how you plan to scale your business, not just in terms of projections or the market share, but really month to month, year to year, how you're going to make it, how you're going to be the one project that delivers these multiplicators to the investor that they're actually looking for. So the three of the aspects you always have to consider when thinking about, is your business idea, product idea a good one? Is a problem, the solution, and preferably the better or faster or both, rather than a cheaper solution. And the final one is a business model. Basically, this is the filter and the final test if this idea is actually profitable and can it be an interesting business to invest into. And to answer this question, we're going to be looking at what a good idea is actually in terms of investing into a good one. So there's several aspects of a good business idea that we have to consider when talking about building a project. And when we talk about a business idea, we have to understand that while it's still a business idea, even if it's a very um, short hypothesis, it's still a theory that has to be adopted into a project and the Airbnb or a business, and to be validated. Because before evaluation, before the validation from the customers, from the paying customers in particular, this is just an idea. It is just a theory, a wannabe idea that has to be validated and proved before we can actually talk about the business aspect of this idea. So there are usually 3 or 4 aspects of what makes a good idea, a good business in the future. First is desirability. Do the people really want it? And there are different reasons why people want certain things. And we will not be going into the psychological aspects of desirability a lot today, but it has to be proven on the level that people are either switching to this project, or you already see that people are looking for these type of decisions. And Reddit, for example, is a fantastic space to look into the insights of your customer, prospective customer, to find what they're actually looking for, what they would like to be paying for at this time in this particular niche that you're going to be covering. And the last one, desirability, is also about the fact either the people recommend you or they not. And this is a very, very old concept, but it's still working in the current way. If people are talking about your project, are they talking about your solution with other people? For example, with their friends, if we're talking about B2C markets, or they talk about their co-workers, it means that you're not only desirable to these customers that you already have, but they are serving as network effects ambassadors, creating an additional desirability in the potential customers. And this is one of the best things you can have when there is a word of mouth that is actually bringing you network effects and increasing your desirability among the people, especially on the early stage when there is maybe a limitation to how many customers you might properly address in your business, especially in B2B, for example. But this is one of the things that is very, very important starting from the very early stage. And you have to look at the early adopters that will become your brand ambassadors and product ambassadors from early on. Visibility is another great aspect. Can you actually build the product that people are looking for, and can you deliver it within the time frames that are desirable for the customers? Because a lot of times there's a good idea, there's a good technology, but you might not have the exact resources to create a business that is going to be the best one to serve the interests of your clients. Because if it's a good idea, there might be other competitors trying to build the same product. So you have to really consider if you're going to be the one that's going to deliver. And it goes both in terms of technology already being there, being available to create, or going into marketing. Are you going to build a business that is going to be available for the clients that actually looking for? So this is about communication as much as building a project, because technology nowadays is something that can be created quite easily, relatively easily, in comparison to what has happened 5 to 10 years before. And you really have to have the capacity to market it in the way that you can actually deliver it to the right customers at the right price. So feasibility is one of the aspects that is very hard to sometimes ascertain yourself. So this is the good space to actually get advice, to get other people's opinions, especially if you're not a technical founder yourself, because sometimes we might miscalculate how we're going to actually deliver results on terms of time frame and the terms of cost of actually delivering it, both in terms of production, both in terms of marketing. So the last aspect of this is actually the business model itself. The business model itself naturally answers one and only one question: can it make enough money? And enough money is a very, very interesting phrase, because it has to make enough money for both you and your investors. Because if you're looking at the venture capital model, it means that every investor is looking for this one unique company that's going to be returning the whole fund. If you're talking about VCs, if you're talking about the angel investor and they have a successful portfolio, we're talking about the angel syndicate. They're going to be looking for the numbers that are going to support the idea that this exact unique startup is going to return all my investments and more. So business model basically helps you decide whether you're going to be building this product or not. Are you going to be spending all your time, all your energy, and all the resources on creating this particular business solution, this particular startup or not? And it's not to kill the idea, and it's not to kill the dream, but it's just to make you and if to make help you make an informative decision how you're going to proceed with this idea. If it's desirable, if it's feasible, fantastic. But if it can make money and scale on the level that it can be supported by venture capital, then it's a good business idea in terms of building a startup. If it's not, it's still might be a good business idea, but it might be not just a good startup in terms of technical aspect of it, how we usually see startups growing 10 times every month, every year. And it might be just be a good business solution where you can be a solopreneur and be quite comfortable with the amount of the revenue that this project delivers you, but it won't be a startup in a classical sense of the world. So a good idea in terms of investors, in terms of the VC market, is actually something that desirable, feasible, and is scalable in the time frame that is making sense for both investors, you and your clients. So this is quite a sweet spot you have to achieve in developing your project, and not every project stands the test of this approach. So why we talk about investors so much on the call that is actually about the startups? Well, sorry. because the investors are looking at what the customers are saying, even more so as they're looking at the data about the startups. Years before, the traditional approach to finding the startup was the startups to basically go after the investors that they know are investing in their sector, in their industry, in their stage. But nowadays, because there has been quite a lot of projects and they're approaching investors all the time, a new approach to investing proactively has emerged, and more companies are approaching startups rather than the other way around. What it means that they are evaluating the idea even more than you do sometimes. And sometimes they look at what the customers, your customers, are saying even more than you might be doing. And the customers are a centerpiece of these conversations because a good idea is something that is validated by numbers, but these numbers are provided ultimately by customers. Um, of course, there is an element of put a spin on every number, and we know that it can be updated and can be covered by different metrics. But basically, if you have customers and you have paying customers and you have enough of them, and the LTV of these customers is good enough and the churn rate of the customers is good enough, it means that you really do have a good business idea and you can create a business model to support it. And you build this idea of the business model and financial model ultimately based on the data from your customers. So understanding what your customer actually needs is the paramount approach to building a business. And basically, you don't know what you need to build unless you talk with the customers. I know there is a very, very popular and myth of approach that Steve Jobs has created, that you don't have to talk with the customer because the people don't know what they need. And it is a very popular idea, but it's not 100% true because, of course, Steve Jobs himself didn't talk with the customers, but he had a lot of marketing people doing the same thing. And even the disruptive technology, disruptive upgrade in technology, in how we sense the technology, how we tend to use things, it don't happen out of the blue. They happen because a number of aspects combined provide the data or the signal for the people or the companies that are working on the next big thing, that they actually have to pivot into this direction. This has happened when the smartphones have been developing because iPhone was not the first smartphone that has appeared on the market at the time. It was the one that was marketed best. So when we talk about disruption and we talk about the customers, we have to know that there are direct communication with the customer, and there is the market data and the customer feedback that can be used and should be used to create the best solution you can possibly make for them, because it's easier to sell the people what they need and what they want because they're already waiting with the card online or, for example, in the store, just willing to pay for something they need, rather than to tell the people that, oh, no, you actually need to buy this one and it's good enough for you to spend your money on. The first approach is much easier for you to create this scalable machine of revenue rather than trying to make people buy something that they're not 100% certain they actually need. So, every idea without approach to the solution is a non-tested hypothesis. So basically, this is one of the problems that we see with a lot of founders. They usually tend to have a very nice idea that they really do believe in. And this idea and this belief might even be supported with numbers, but it doesn't necessarily mean that numbers are good enough. And then they're looking at the right numbers at the same time. There might be a very good idea and it might look good on paper, but if you don't support it with the right amount of metrics, it is a very wrong approach to build a business. You can try to build an MVP and you can try and test drive certain ideas, but you have to pivot until you have this product market fit that will make you actually um, that will actually be the sweet spot of what the customer wants, what you can actually deliver, and what is scalable and can make enough money for you to go down the VC route. So when you assume anything about your customer, you have to test it and basically to validate it on numbers on the scale big enough to make an informed decision that is not in the margin of errors. And then when you know for a fact, then you aggressively, and you scale the business to the maximum extent that you can at this level, and then you do this again and again and again. So this applies to basically everything. The whole idea that I want to build a product like this because I see people uh, writing negative reviews about certain services online, but you have to know, are these 90% of the people that are using this product, they're sending these negative reviews, or this is the 5% of the most vocal opponents of the project, and the people just like to spend their time doing this. So really have to consider human psyche, and you really have to consider all the numbers before you jump to conclusions. And it does really apply to everything. You have to test drive through A/B test and other approaches, the pricing, the product features, the marketing channels, the customer segments, distribution model, especially so if your project has a physical aspect to it. Even if you're building the technology, if you're being something that is going to be used in the mass market in the B2C, for example, and it's something quite generic but quite effective, and you know that this is desirable and feasible for you to produce, you still have to think about the segments because there's going to be the early adopter segment, there are going to be the followers, there's going to be people that are going to be switching because of the pricing, people going to be switching because of the influence of the bloggers they follow or anyone else they follow, and they think that they know what they're talking about. There are a lot of things that you have to consider before actually building a product. And the more version you test drive, the more combination of things you test drive, the more precise data you will have, and you will actually make an informed decision whether you're going to be building this project further or not, which sometimes can drive you to the conclusion that this is actually not a feasible project and you have to try the whole different idea, a whole different concept, which sometimes can be very painful. But I urge all the founders that we work with to be open to the idea that this idea of the business or the project that they have might not be supported by the market. And the earlier they get this idea, they get this message, is the better, because it really helps them to be more agile and to adapt to the market needs faster. And this is a skill rather than attack on the personal, professional capacities. And it just really helps you to use the resources you have the best way possible and to pivot enough times to arrive to the solution that is the best for the market. And if you look at the best and the biggest corporation that we all use, products of which we all use nowadays, starting from Amazon to Uber to Dropbox and everything, they all started with the wrong hypothesis. They all had initial idea that it was not what we know them for today and not what made them famous. They pivoted a lot of times before they get to the point that become successful. And this is what actually distinguishes the startup founders that are just having one idea and sticking to that, to the idea that they like, but they're willing to test drive it and arrive to the better idea after that. So I'll talk a little bit about the journey to Series A because it has changed drastically. I covered a little bit of that before we started talking about the investors. So before 2023, 2024, the idea was that for pre-seed startup, you basically have to have a concept MVP. It was more than enough to get investments, especially in certain areas. On the seed stage, you were supposed to have a business model, a validation. So you had to have enough customers, a good amount of ARR to be able to scale and to provide the basic fundamentals to actually be able to provide the information that you're going to be working towards even higher achievements in your Series A. And Series A usually were about the scale and going to the new markets, going to the new segments, maybe add a new product to mix and such. Nowadays, it has changed drastically, and there are basically two very different investment markets are nowadays. First is for IE and big funds, strategic big funds that exist in the United States, and the second part of the market. So if you look at the news, what funds have received the most financing from the limited partners, this is how the funds actually collect their money to invest in the projects and deliver results to the investors. You will see that more than 70% of all the capital distributed in the United States went to the two investment funds. First is A16Z, A16Z, and the second one is Sequoia. They're the biggest funds in the world nowadays. They manage billions and billions of dollars. And most of the time, these two funds nowadays, they focus on IE. And you know that a lot of companies nowadays are trying to make themselves AHS and pivot to the IE projects. And there's just a crazy amount of buzz about IE projects and the evaluations and such. just last week there has been an event in California, which is annual event. It happens every 4 months nowadays. This was the demo day for Y Combinator. And Y Combinator has changed their approach to investing and to the batches formulation drastically a year and a half ago. Before that, they only had two batches a year, which was summer and winter, and they had a limited amount of application, and they only considered startups with a certain diversification in what they were doing. And a little bit more than a year ago, it changed drastically, and now almost 90% of all the companies that are in the YC batches, they are doing something with regard to AI. And second thing is that they now have four batches. So they have companies in winter, summer, spring, and autumn batches. Why it's important? It says a signal that there are actually not enough of good projects for investors to invest into. And it means that investors are actively looking for good projects to invest into nowadays. And they're looking at the feedback from the customers, they're looking at the feedback from the partners, they're looking for the feedback from their portfolio companies. So being in the know and know the right people and being able to show good numbers and being able to listen to what your customers are saying is not just a nice have to validate idea in the beginning, also something that can actually distinguish you between a successful project that will get the attention of the right investors or not. And it means that though there are a lot of focus on AI projects at the moment, it doesn't mean necessarily that you can only build a successful project if you build an AI. It doesn't mean so. But it means that to be considered valuable investment, you have to be more active than these type of projects and go after the precise evaluations of what you're doing and go after the business models and being able to provide the data about how you're going to scale even more so than before, which means you have to think about that starting from the pre-seed, especially when more and more funds they have become a little bit more conservative and then don't invest so much in the pre-seed companies as they used to because there's higher risk and higher percentage of chances that the AI revolution that we currently have will influence the business path for these projects that are not AI focused at the first place. So business model, scalable approach to what you're building and verification of the data in the metrics is necessary from the day one. When I will be showing you a demo version of the business model, you will think probably when you'll be looking at this eight parts file that it's too much. And I totally agree with you. That's a little bit too much for a preset, but it just covers all the basics, how you can actually take this basic idea of the business model and take it further. And it can also give you a necessary angle to what you build in later. So basically, when we go into the decision of a validated business idea, what you have to consider, what answers to what questions you have to consider. First is that with regard to how the market change all the time, with economical, political situation changing and new technology appearing almost daily, there's still certain question that your project has to be able to answer. First is where do you see yourself in 3 months, 1 year, or 3 years? I know this is type of question most people hate, especially founders, but it doesn't mean that you have to know specifics where you're going to be. It means that you have a certain vision and you have a path how to get there, and you know what signals you're looking for and what data is going to support your journey. So you know what numbers are the most important for you. You know what you have to track daily or weekly or monthly, and how you're going to make an informed decision that something isn't working the way you decided it should be working, and how you're going to pivot and make amends. Second one is that you have to know what investors expect to see in your particular project. If you're in a certain niche and in a certain type of business, you have to know what the successful businesses have been providing for the investors before in terms of the verification of certain numbers, in terms of what aspects of the business you have to think about. For example, it's the delivery time, logistics aspect if you're building something physical, or the seasonality of your business. So you really have to know all the aspects of your business better than investors, especially if you're looking to for investors that have already previous experiences in your industry. So you have to know more than them. Obviously, you can have advisors, obviously, you can have additional support, but you'd have to know your piece. And the second thing why why you think about business model, why you have to think about it, is also an internal tool of efficient management style. Even if there are just a few co-founders in your business and you're very pre-seed, there's still different types of things you can be doing at the same time. So business model can be this type of strategic North Pole document that will guide your decision making, because sometimes it's very hard to concentrate on the things that are the most important at the moment. So they actually having a validated business model helps you to stay focused on what's important, was it just a noise, and you have to pass it as soon as it appears. So business model is also a way both to be strategic about setting your goal and achieving your goal in the timely manner. And the last question you have to consider is how you're going to be cutting through the noise and through unexpected expenditures along the way. So how you can actually deliver results faster and easily. And if you don't know the answers to the whole question that are here, which is fine, but this is the types of the question you have to be answering in the business model and even in the theoretical hypothesis that you currently have. So how we'd actually do this? Um, Financial or business models basically your navigator. So there has to be certain aspects of it that you have to consider. First, you have to evaluate and forecast all the activities that you're currently doing. It can be the delivery of the main technology, marketing, packaging, customer service, anything and everything that actually involves talking to your team members, to your customers, anything that can be either used to your benefit or can make or break it. Second thing, you have to optimize everything, and it has to be go-to approach. Even if you already have certain investments or have very good technology, there's still approach that can get you to optimize certain cost, for example, and you have to go and consider how you can actually make your revenue bigger and for example, if you have post payments, how you can make this post payment shorter, especially if you're working with the corporations. Competitive edge is anything, everything that can make your project stand out. It's either unique experience of your team members or unique technology or unique approach to closing the deals with your customers or unique marketing channel approach that you can validate and scale afterwards. And last thing that you have to consider when building a financial model and business model is basically the team alignment. It means that you really know what every team member is doing, and their personal KPIs are aligned with the business KPIs. And it sounds very natural and very organic, but we see this all the time. As soon as new people are added to the teams, because they just needed some job has to be done. The usual aspect of it that we see a lot of time is that the concentration on the strategic KPIs erodes after some time, because there's just so much things to be done daily as routines that the strategic thinking about what we're actually doing, where we're running, why we're doing certain things, it can be it can become very murky. So business model and alignment of your smart KPIs and the action plan of all of the members, even they doing just, customer support, they have to be aligned with the financial model, because if you don't do this, you're just losing your money and maybe spending money on the salary of the people that are not the most effective, or spending on the roles that are not the most necessary for your business at this time. There is a very good concept or framework, if you like, to how we actually make financial business model. This is what is called the FAST standard, and it's universally accepted, one of the best approaches how you can actually talk about the project and how you can actually approach it. So first, it has to be very flexible. As we covered it earlier today, there are a lot of things that can be gone wrong. There are a lot of fluctuations on the markets nowadays, especially this year. So you have to stay flexible, and it usually means that when you're building a financial business model, you have to consider different scenarios. In more mature startups, investors are usually looking for 2 or 3 versions of your business model. For example, the optimistic one, when everything is going smoothly and all the things you have to deliver, they are being delivered on time. The one can be negative one, but I don't recommend actually calling it negative one, because I'm talking with investors about it, but something that is a little bit more dim view, and it gives you another version of your future, another version of how you're going to be doing things if something goes wrong. And you can possibly think about the risk aspects of your model and decide what is actually can go wrong and just act accordingly. And the more you know what can go wrong and have solutions beforehand, the best, because it actually shows you flexibility in terms of adapting to the new markets. And basically, this is the main thing that investors are looking for: your ability to pivot, seize the signals, and act accordingly and make smart decisions, even in a lot of pressure. Appropriate is fit for your purpose. So appropriate means that you have your goals and your tools and your intermediate KPIs all aligned, and the path you choose to cover these KPIs actually makes sense in delivering the strategic KPIs and strategic OKRs if you choose to go down this planning road. And it makes sense in terms of the revenue you receive. For example, you can't be building a huge project and only 5% of the customers are paying customers, for example, but they're paying enough for you to actually make enough profit to be effective in terms of CSS and customer retention. If it fits the purpose, perfect. If it doesn't fit the purpose, you probably have to think about it and adapt a business model and maybe pivot a little bit there. Structured, it means that it does make sense in terms of organization of the files, of the data, and there is a certain internal logic, and it's clear and easy to use not only for you and your co-founders, but for your team members and investors. So it can be read and understood without your narrative basically on the call. It's something that any team members can approach, understand what they have to do, and act accordingly. And transparency is basically about building clarity and building trust with your investors, because you don't want to hide the figures. And the more you do to build this trust from the day one, the better, because this means that you're someone who can, once again, um, see the mistakes that have been made or see the changes in the markets, act accordingly, and you can ask for help or ask for additional resources when needed, or can provide additional support for your team members, for your customers, again, when needed. And it can be transparency can also be something in terms of building a product, building technology. There has been quite a lot of scandals in the recent years about the technology not being the technology it was supposed to be, especially in AI aspect, because sometimes, quite a lot of times actually, the technology that is being called AI is not AI, and you have to be very transparent about what you're building. And it's very bad idea to actually not be, because ultimately everything can be proved, everything can be approached, and if you're sugarcoating certain things, it might be okay for a certain extent, but if you're building something that is not what you actually are supposed to be building, you have to stop and reconsider your decisions. So first is a good concept of how you have to build the financial business model and what you have to look for in terms of understanding whether you're ready or not. Generally speaking, there are two approaches to building a business model. First of all is experience-based. It relies on the previous examples, either the businesses that already exist on the market or have been existing on the market shares, addressable market, serviceable addressable market, as such. This is something you can start while you just have an idea and you just really have to understand whether it's a good market and you can reach certain scale or not. It's usually something that is used for the exploration stage, very, very early stage. Maybe you're not seeking investments at this time. You're just considering doing something that might be a good business idea for the next 5 or 7 years. When you're going into fundraising, you have to have a data-driven analysis. Basically, what it means that you adapt the micro threats, you adapt what you have recovered from the early exploration stage, and you actually build a model about how the finances in your company will make sense. It combines the expenditures, it combines all the costs that you probably have, it combines all the taxes you have to pay, if any. It combines all the seasonality, all the aspects of your industry that you have to consider, and basically it gives you a glimpse at what you actually built in terms of finances, in terms of the availability of resources that you actually need, and if you in your particular company can meet these requirements to get these resources, and what amount of money you expect to be making in every quarter, in every year, and such. So data-driven analysis, again, it depends on the stage that you're at as a business, is something that you really have to be in the conversation with investors, especially with VCs, with the companies that are distributing funds, because this is basically a business for them. They have to verify your data and you have to collect, analyze, and provide this data before you go into the conversation with them. So how do you do this? Well, we already talked about that you have to talk with your customers and you have to do this constantly. Since they have been prospective clients, then they have been onboarded to your product and whitelisted using this. And if it happens, you have to talk with the customers. They leave your service, especially if you know why they're leaving. For example, they mentioned in the test or the feedback that are switching to another company, to another solution. You have to know exactly why they're doing this. You might have your own assumptions, and they partially might be very right, but you have still has to talk with them and know for sure why they're leaving, especially if this is something that is happening at scale. So first of all, you have to define your market potential, and you have to be um, very realistic about this because I see dozens and dozens of pitch decks monthly, and investors, professional investors, they see even more so. And one of the things that usually stands out for me is that the market potential is um, almost every time is blown out of proportion. So it's usually a huge market, huge opportunity, and no competitors, or very little competitors. And we have the unique idea how we're going to conquer all this market. It sounds very promising, sounds interesting, but from a professional standpoint, it's not actually a feasible idea. It means that something has already happened, somebody has tested this idea, and it didn't work out because um, there are not enough of very obvious business ideas that have not yet been covered. So you have to be very specific and really know why you define this market potential as it is. There are different approaches to how you can actually define the market potential. You can Google it, you can ask ChatGPT or Claude, but the numbers in this section have to make economical sense, especially if it's your first time building a business and you're just at the very early stage. It has to make sense how you're going to be going from the company that is just starting their journey to addressable market that you would like to achieve in $1 billion valuation. Second thing, you really do have to properly analyze competitors. And it doesn't necessarily mean all the competitors that are providing the same services, but you also have to consider what your customer is spending a lot of money on. For example, if you're entertainment, your competitors are not only games, but Netflix, but concerts and maybe some other live events. If you're in business, in B2B business, you might be actually competing with AI solutions or the corporate solution or something they have on the side and they're not telling their boss that they're using. So you have to really build this trust with your customers and build this trust in a sense with the data that your competitors provide to really know why they're doing what they're doing, what is the reasoning behind it, so you not make the same mistakes they did and just accelerates your growth exponentially. The last one is understand your audience, and you really do have to understand the behavior of the customers because we tend to rationalize our decisions far more than we tend to tell ourselves because we like to think that we're very emotional, and there's a lot of manipulation on the market. So you really have to think about what the customer is experiencing, what is the context of your product in their life. And once you understand that, you have valid data from your customers, you can actually use this for your marketing, for your communication, for building the successful channels for marketing, or really craft the features of a product that the customers really need. And the last thing is test speed and price, the classic A/B testing that you can use. How much you can sell, how many things you can sell, and it's important not only for the businesses that produce something physical, but it's also important for your digital service if you provide one. Because even if you grow exponentially, for example, so there can be certain bugs, certain problems with certain features. Are you going to be able to actually support the growth that you have? Because sometimes it's the problem that a lot of startups have at this growing stage when they don't have enough of customer support specialists, or they don't really have the structure to support their clients. They just only have the onboarding, and they actually tend to have a higher churn rate than the startups at the later stage because of that. So you really have to consider all these aspects, how you're going to become a more successful project than your competitors, and how you're actually going to build a company that can create a great added market value and become one or two on the market in terms of the size and the market share. But to do that, you have to be really humble and to be really good with numbers, and you have to be able to look at the numbers, tell you that it's not going to happen. And it's very hard to do so. This is why you try to collect as much data as you can and be as realistic, as fair with the numbers as you possibly can, even if it's painful. So this is actually the 8-block business model framework, and I will show you the Excel file we tend to show our customers in a minute. So basically, it has to cover the 8 blocks for you to be a successful business model, financial model. Basically, it's a control panel that collects all the necessary data about your product, your technology, your team members, and your finances. So think about it as a certain dashboard that it would just collect all the data that is both what you plan for and what you're really expecting in the moment. It's going to be updated automatically, of course, because you have to have all these transactions and all these other data resources to be combined in one space, and this is the perfect space to have it. So first of all, you have to track customer base, obviously. You have to track both the amount and the quality and the segments and the number of interactions they have with you, how they're going to be using your service. For example, is it something that they should be using daily, or is it something they can use occasionally based on their needs? You have to really consider the things and build accordingly in terms of marketing, push notifications, and everything else. Macro data is basically macro data about the company rather than the product. So you have to think about the indexes, the inflation, what are the external factors actually affecting your business in a negative or a positive way, and how you can actually use them and manipulate them to benefit your business and your product. In terms of marketing, of course, this is the seasonal holidays that happen in the United States, for example, the general calendar where you can be heard better, or when the cost of acquisition is too high, so you just slow down your marketing communication, or some partnership they can consider doing in certain aspects of your business to make it more profitable and such. Capital expenditure is basically everything that is connected to your business as a business. So everything you have to be doing, like VAT, community of investment, if you already have one, if you have any debt, for example, or any other things that you have to consider, this goes into capital expenditures. Then it's operations. This is all that you receive, the revenue, variable, fixed cost if you have them. Again, you have separately taxes, all the types of taxes you are paying, or if you're in certain areas, in certain special tax regimes that you're not paying, but you know that in a couple of months or a couple of years, probably you'll be starting paying taxes. So this is something that you have to consider. As terms of the funding, this is the commitments that you already have, the soft commitments, or the money that you're already receiving. It can be in terms of grants, it can be shareholders, it can be advisors, it can be investors, anything and everything that is actually involved with the funding. And the last one, but not least, obviously, is efficiency. How much runway do you have is the first thing you have to consider, and everything else in terms of production, if you have a production, and any other things that are relevant for your business. For example, you apply for certain protections because your technology is so unique, and you have to know when this protection expires, and anything else that is relevant to your business. And obviously, when you're very early stage, you don't really have to know all the numbers, and you don't really need everything that is listed here. But if you're already past the very early stage, and you're already at seed stage, for example, these are certain things that you have to consider, and you're expected to consider when you're working with investors, because this is something that it will ask for eventually in terms of quarter reports or yearly reports, again, depending on who your investor is. And now I will look at the comments that you probably have at the Zoom chat, because I saw certain messages there, and then I will show you the the live document. Okay, I saw. Dmitry has to run. It's okay. So now I will show you the Excel file that we tend to use. Obviously, this is just one version, and you can use another one if you know that it works best for you. But I'll just go through the logic of the document in 5 minutes so you can ask any questions you might have. So I suppose you've seen my screen again. Um, I will just try to make it look a little bit closer because there's a lot of things here. Just give me a sec. So basically, when I talked about the uh, document, I talk about it being an effective dashboard that you collect all the data and you have everything in one space. Why I recommend actually having one type of the document where all the data is collected? Because it just makes your decision-making process far easier. Because when you have different types of documents and your team members are working on different types of documents, it makes it harder for you to have access to all the things you need on momentarily basis, basically. And you really need to have something like this. Obviously, this is not the only format you can use. You can use another one. You can use an actual dashboard and have something online, be it with AI again, or something internal, or can use Excel files. Both of them are accepted by investors. Both can make sense for you. So basically, this is how it works. So you have to know what the things in the model you're fixing in the business model, what you should not be messing with, and the things that you should be updating. So in the control panel, everything that is listed uh, in the other parts of the file is combined, kind of executive summary. So you have all the necessary data about the customer base and orders. Again, orders if you have the physical product, or purchases if you have, or subscriptions if you have a digital one. And you just have this prognosis based on the years and the months of the year that you're currently in. You have the seasonality index if you have one, and you have the combination of variable and fixed cost, and we'll go into through them in a minute. And you have the payment schedule, and it's extremely important if you're working with corporation enterprises, because if you're just building a business that is B2C and you just work with them, the customers that have subscription, for example, or they have opportunity to buy as they use, add to subscription, anything, it makes the process of managing the finances a little bit easier than working with the corporations. This is why for B2B companies, so important really know how your customers are paying you and when they're paying you, because one of the problems that we see with the B2B companies, especially if they're at the early stage and don't have a scale of the project, is that they don't have enough cash in the moment when they have to spend it. So there might be a disproportion of expenditures in 1 month or 1 quarter, and disproportion of the revenue received in another one. So you have to look at these numbers and to be sure that you actually have enough cash to run the business in these couple of 3 months while you're still waiting for the big payment from your client. And it looks like, sounds like a very easy logic, but when you really know that there are chances that the customer will not pay in time, this is when it tells you the data that actually, yes, by the contract they have to pay every 30 days, but the average amount of days they spent on actually paying the invoice you have provided for them is 45. So you know this data and it shows you automatically here, and you can build this model in a way that it will tell you that, okay, we have to push certain payments for the later stage because we will not receive the payments in real life. On the paper, you will have to expect it, but it will not arrive in the time that you really need. So this is the types of things you have to consider when building business model, not what you expect to happen, but to collect this data from the previous months to be sure that actually it's going to happen in the time frame that you need. Obviously, as I mentioned before, because it's a combination of the things you need depending on your stage. There's certain things, if you're at the very early stage of your business, you might probably not need. For example, the authorized capital is usually something that is used in a far more developed businesses at later seed stage or Series A. But basically, it helps to cover uh, your um, your basic requirements for the investor. So you know how you're going to receive the investments, all the debts, payments, and such. So here we cover the macroeconomics, the inflation rate, why it's important. Obviously, even you're not building a physical product, you have to raise your prices from time to time. And again, you have to test how you're going to raise your prices, to which consumer segment first, and how much, and what the competitors are doing, and what are your tax rates if they're changing year to year, for example. You have to consider all the things. And this just basically shows you how the um, prices in terms of inflation are correlated to the tax rates you have, or for example, the payments that you're going to be receiving from your clients. Because most of the time, if you're especially building a B2B project, it's something that is actually in post revenue. So this is a summary how it may look. So you have graphs that can be automated. You have certain aspects of the financing here, project efficiency, which is very important, especially at the early stage. Profits and loss statement. Obviously, this data is an example, and it doesn't show the data of a real project because it's all in red, but just to show you an idea of how it actually looks like. Obviously, depending on your jurisdiction where you add the profits and loss statements and other documentation and the reports you have to provide for regulatory officials and to investors are going to be different. But in a nutshell, you have to consider what your profit and loss statement is going to be, either with VAT or excluding VAT, again, to calculate the retained earnings and how you're going to be distributing the revenue if you have it, either in dividend or reinvesting in the business or using it to maybe covering the debt that you probably have acquired or something like this. So basically, this is the part where you look at the financials of your firm, at the financials of your project. So what is your cash flow? Cash flow is very important, especially at the growing business. And even if you have the investments, you have to consider runway and you have to consider it here. And you have to consider all the investment activities here as well in comparison to the macros like tax, inflation, and competitor results in the previous quarter and the customer base, which we'll be covering in a minute. So for customer base, you have to consider different types of metrics. Obviously, it depends heavily depending on what you're building, but basically you have to consider your marketing costs because it's one of the biggest things that either make or break a project, especially nowadays. Then you have to consider the accumulated customer base, basically how much new customers and paying customers you're receiving per the increase in your marketing spending, for example. Again, if you're having something built physically, you have to consider the correlation between the orders, customer base, and the marketing. So basically, how much money do you spend on creating one order? If it's enough, I have to amend the prices. If you're working through the distribution channels, you have to to consider all the distribution channels here as well. It might be stores, it might be other partners and their online websites apart from your own website, for example, and how many people do you really need to deliver these results. Even if you're building an online project, you have to consider this as well, because if you're growing proactively, you might not have enough of staff in terms of customer support. So you're either building something with AI to support them, and you just have a little bit of managerial stuff to manage the AI agents or something, or you're going through a personal approach, again, depending on what's your project, what's your niche. If you're in the premium services, probably it's better to have more real-time human customer services providers and such. So all the things that are related to your customers in terms of how much you receive from them, what is the cost of acquisition, what's the cost of acquisition per order and per staff member, you have to consider here. Because it's if you go into negotiation with your investors about the hiring needs, this is the things that you're going to consider. This is the data they will need to either support your decision that you need to hire 5 more people or kill this decision because you don't have the data to support it. We covered the macros before that. I will not be covering them in a lot of details, but basically you have to consider three types of things. First is seasonality, and even if you think that you don't really have a seasonality, your customers do have them. Depending on what your segments are, you have different types of seasonality. For example, for the people that have kids, they live according to their school year schedule, and their budget is built accordingly to the needs of the children or the school or the projects and other activities that they have. If you're catering to the singles, especially in a certain age, depending on generation, you have to consider something that is happening in the young people lives, for example, festivals or offline events, especially for the Generation Z. If you're building a project that has millennials as the main customer, Then you have to consider all the holidays and all the things that might be a person with within the sandwich generation consider in their life. Sandwich generation is when the person is actually taking care of the kids and the older people in their family. So there's always seasonality, and you really have to know your customer to know which seasonality they have, depending on the segment, because it will show you that you can expect certain deflations in the number of orders or contact with your project in certain months or certain weeks, for example, and you can double down on your investment in the marketing in these days. Or you can actually use a certain holiday or certain other event in their life to actually build additional marketing channels, communication, so make more of the positive spending trend that they have, for example, in November or December. And you have to consider the inflation and the cost of building your project. Even if you're building something online, your providers, for example, online services, Amazon Web Services, and other companies, they still have their changes to the pricing. You have to consider this too in your budget. So everything that goes into expenditure and the seasonal changes of your expenses, you have to consider this here. Obviously, you have to consider your variable and fixed cost because your business that either paying some team members or founding team members, or you're paying for marketing, or you have some kind of agencies on the payroll or something. You have to collect everything here and actually connect the expenditures with the revenue, with the ROI into these investments. Cash gaps are one of the main things you have to consider, especially if you're B2B. And it's usually the number one problem that kills a project in the first year, because usually enterprises are very long clients to even consider signing of the contract. It might take up to 14 months in UK in some cases, a lot of cases, and a lot of industries, unfortunately. It means that it might take up to 16 or 17 months to receive the payment from enterprise client, and you're still going through building expenditures. So you have to get a clear idea where you're going to be getting this investment. Either it's going to be a bootstrap project, or you have early adopters from the startups or companies with less bureaucracy. In any case, you have to look at your cash gaps very realistically, because if you run out of money in today's market, you will not be able probably to receive the payment from your investors, the bridge round or additional funding in the timely manner. You have to consider it to take quite a few months or at least weeks. So cash gap is the second most important thing you have to consider. Obviously, taxes, if you pay them, for example, if you have some inclusions, you cannot pay tax. You can possibly not pay tax for some time, but if it's going to happen, you have to know when it's going to happen and what is projectile of these payments. So you have enough cash and enough resources to actually cover these payments, because you have to be legally ready for paying these costs. Obviously, if you receive the funding, if you're one of the lucky ones, you have to consider how you're spending their money. And depending on the type of the investment or the funding in general, you have to consider either expenditure on the debt that you're paying. For example, you have a loan for the bank or something, or if you don't have the borrow funds, you just have to consider how much options you still have and what is the market, what is the capital for the founding members, and how much extra capital you probably have to consider attributing for new investors on the next stage of investments. And you don't really have to give them too much of your company share too early. So this is one of the things that you can use to actually decide how much money you're seeking in the next round and how much equity you're willing to give away for this funding. And basic calculation efficiency, it's just a combination of the things we talked about in terms of operations, investment activities, marketing activities, all the costs you have to consider that you currently have, and all the main project performance indicators basically here. They are usually the ones that are used at the more advanced stage, but basically they tell you the financial health status of your company, whether it's is doing good or bad, because sometimes you can see a lot of things happening at the same time and you have a good overtone, but at the same time you don't generate enough revenue and you don't have a clear path how to generate more revenue. So if something is off, it will show here, and you can understand what you have to do differently. For example, cut their operations or marketing cost, or decide to go into another financial and business model, for example, with certain clients, adjust to the inflation, adjust to the growth of the prices by the competitors and such. Everything you can do and project is going to be here. And my big recommendation is, especially with AI, you can do this automatically. It's very easy. You have to put all the routes to the data to the places where this data first happens. For example, you have to connect your business model straight to the marketing channels, advertisement results, for example, or to the expenditures from your accountant, for example. So it has to be interconnected. When they're changed in one document, in one report or something, automatically shows in here, because if it doesn't, you will not actually be seeing the data live, and it will actually not help you to make an informed decision any moment of time. So basically, this is how this might work and might look in terms of the business model. But in a nutshell, once again, what you have to consider when building a business model, apart from being feasible, desirable, and a good idea in terms that we have covered today, you have to look at the customer base and the correlation with your customer base and your orders, if you have them, and expenditures per order and per customer. You have to look at the macros, what the market is saying about the inflation, about the, for example, your central bank interest rates, what is happening with the competitors and their pricing, what is happening with your expenditures. For example, you have to consider paying more for your marketing, or some person that you cannot let go wants to receive more salary, and you have to consider if you can actually afford this or not. And again, if you have funding, how much of a runway do you have, and what are the terms of the payments from your B2B customers in real life, not what is actually put in the documents, if they're taking much more time to make a payment than they are supposed to. So I think in terms of the demonstration, this is it. This is what I wanted to show you today. If you have any questions or would like me to go back to any types of information before, we can absolutely do this. I will just show you a final slide that might be inspirational. I hope it to be inspirational, but it also might be a little bit disappointing for some of you. This is how the investors, especially the VC funds, expecting you to perform for you to invest, for them to invest into you. Basically, every institutional investor is looking for the types of projects that it solely will return the investments of the whole fund. So basically, they're looking for these companies. If they succeed, they will, and every other project in their portfolio fails, they will be able to return all the funds with extra revenue for the fund and for the fund's investors. So the minimum that expected for this whole business model of your investor to work is at least 10 times the investments in your project during the exit time. For different stages of the funds, it can be different, but if they invest into you at the pre-seed stage, they usually sell their share by Series A. It changes, obviously, it's a very individual decision, but most of the time they don't spend more than two stages, more than 3 or 4 years, because usually the vesting period is 3 or 4 years, and the returns of the investments from the fund is 8 to 10 years, depending again on the stage of the business. But ideal return for the business of investor is 100 and more, because they seek in this unicorn potential to return all the investment they have made. Obviously, not every fund, not every generation of the fund is going to have a unicorn, but this is what they're looking for. This is what they want to see in the company. This is why they sometimes are triggered by unrealistic sales forecast or realistic market share evaluations, because it says that you're here for the short game, not for the long game, because they would like to find a project that can realistically say, okay, we're going to be growing slowly for the first year, for example, but on the year 2 or year 3, this is how we're going to make it X times better than we did in the first year. So you have to really know your game, your industry, your customer, your competition, and market penetration cost to make sure that you can actually deliver what they're looking for. And basically, this is what they're looking for in today's market. Even if you're AI project, they're still looking for these particular results. So this is the last thing I wanted to cover today. Thank you so much for being with me for this hour. I'm so sorry for being late and making you late for maybe other commitments that you have. But this is what I wanted to deliver today. And any questions you have, please do ask. And if you find any questions you have later, please do find me on LinkedIn. I'm always available for a chat there too. Thank you so much, Martha. Once again, sorry for being late, for running a bit late today as well.
Uh, Questions? I have to say, Christina, I really appreciate that you said a lot of things that I would have said. And
I
it's
saw
nice to,
from your face, yes. But it's like it
yeah,
has to be said, honestly. We have a very good space to be talking real talk today. So this is why I decided to show it how it is. Because it's harsh out
yes,
there, I fully understand it. And I work with investors
harsh.
every week and with startups every week. My very good friends are on both sides of the business. So I have very good friends that investors, very good friends that are startup builders. And it's important to understand both sides to make an informed decision and to decide whether you want to do this at all. And if you want to, how you're actually going to do this to succeed. So this is important to know. Hard truths, as always.
Questions?
I'll go ahead and ask a question if I can.
Yeah,
Absolutely.
please.
Hi, Christina. Thanks for the presentation. My name is Kyle Griffith. My company is called Formatter. We're
Hi,
currently in the
Kyle.
pre-seed stage. Thank you. Um, and you mentioned a lot about data, and I know your product there has a lot of spreadsheets and tracks data and things like that. Um, we have it's a SaaS app. We have a paywall in there, and I'm tracking things through Firebase and these kind of Google Analytics. And I'm just curious what kind of, at a pre-seed level, because we're in a pre-seed fundraising round, what kind of data do you think investors would typically look at? And I'm meaning more like angel investors, not VC at this
Right.
point, obviously.
Can you please give me a little bit more specific about the business model, about the product, and how the customer is supposed to be using your product at this stage?
Yes, definitely. So, Formatter, it's an AI formatting assistant for academic writing. So,
Mhm.
for students and researchers, and essentially what it is that last compliance layer to make sure that your formatting is correct before you submit your paper. So, what we offer for free are insights. So you can upload your document to our website, run it through our AI model, and it will show you all the errors for free. Obviously, you can fix those errors yourself, but if you would like guided fixes and corrections suggested by our AI model,
Right.
then you can pay for that. And you can pay per document. We also have subscriptions on a semester basis for our students, and also annual and monthly for our researchers.
Oh, I wish you were around when I was writing my thesis a couple of years ago because this Harvard standard formatting killed me, honestly. I spent too much time doing that. Okay, so I think one of the main things you have to consider, quite obvious, but still, when you provide such a high value, high additional value product, you have to consider the retention rate. So how many people are going to be using the version that you provide rather than using the results of the analysis that you provide and going elsewhere where they can do certain things for free or with other alternative tools. So the main things to consider here, I would say the behavior of your customer, how much of the problem this is, and how much of the difference of the added value your service provides. So this is the type of things that in the presentation, the pitch decks, we usually call the secret sauce. How you make the product that you have, the solution that you have, such a desirable one that they're going to be switching to your solution instead of using one of the tools they already have. And most of the times nowadays, even the B2C customer, they've like daily users, they use at least 2 or 3 AI solutions already. So this is one of the things to consider. The second one is retention, obviously, because you have the product that is very user specific, role model specific. You'll provide solutions for the students. Students are for like only so long, for like 4 5 years. PhD students obviously longer, and researchers that are usually doing these things professionally for long periods of time, but they do this intermittently. They do in one research, they rest and do another. So one of the things for you to consider is obvious seasonality and how you're going to be going from one generation of the users to another. For example, you have users that already finishing their master's degree or their bachelor's degree, and you have a new generation going into the same business, doing the same things. How are you going to be able to deliver the same results for them? So this is the types of questions I would ask as an investor, as even if an angel investor, which I am as well. So you have to be very adamant that the overall number of the clients you have, the customers that are paying you, and the relation to new customers and new prospective clients that appear on the market is sustainable enough for you to cover. And obviously, with your product being a digital one and potentially serviceable to any market, any educational system that considers the same educational standards, of course, you have to know the go-to-market aspects of other countries, of other regions. They might be compliance factors, there might be regulatory factors, for example, what the universities let you collect as a data from the libraries, for example, and if the results of the work that you do in your program is going to be considered AI result or not, because if not everything is okay, they can use it without any punishment. But if it's going to be considered as unfair advantage on the side, unfair use of tools that they have at their disposal, they might be fined for that. So this is one of the angles you have to consider. What are real-time challenges for usage of your product or expanding your product to other countries, first and foremost. And second one is actually what are perceived fears of your customers. This is the main thing, actually. What your customers really think and what are they doing, because what they think about themselves and their situation might be drastically different from the reality of their action. So back to knowing your customer, knowing the rational and irrational psyche and how it can affect your business plan, basically.
Yes, well, thank you. That makes a lot of sense. I tend to think about Formatter a bit like the Turnitin system. So, it's like a compliance layer, and that's what we're trying to do is be embedded in the workflow. Formatter doesn't generate text like ChatGPT or Claude. And so, in that way, we are attempting to sidestep the question of, is this permissible or not in the sense, because people use spell check every day. And this is something that nobody really likes to do. When you get that desk rejection from that last paper, you just want to
Yeah.
get it resubmitted as quickly as possible. And since we're not generating text, it's your ideas. It's just getting it ready for that next resubmission. So that's I'm just for your
Yeah.
information
I know, I
where
understand. I think it's close enough for some project that already exists, for example, Grammarly, in
Mhm.
certain senses. So you have to know if your product differentiates enough for the customers to switch to your business. Once again, going back from feasibility to desirability of your particular product. So these are the type of things I would consider, and you have to have great answers to investors about these things,
And
obviously.
if from a paid user's perspective, even if it's a small number, are there other numbers besides the number of paid users that I should be showing to investors, or are there other numbers that they might like to see beyond just, a small number of paid users?
It has to make sense in terms of scale, basically, because you certainly have a certain database at the moment. But once again, going back to the very last slide I shared, like you have to show at least 10 times the revenue. Yeah, and by the time the investor is going to exit your company, either through your company is being purchased, or they sell their investment to another investor at the later stage, or any other scenario, because there are different types of exits nowadays that exist for investors as well. You have to consider how this number is going to be achieved and how it's going to be achieved in comparison to the expenditure that your company have. So it have to make sense economically in terms of, okay, we made it X times the investments, but for example, the expenditure level of our company is much higher than industrial average. So it might not be the best ratio, for example. So ultimately might receive worse deal than your other competitors. So basically, you have in these types of projects, I would suppose that the efficiency of your scalability and sustainability of your LTV, churn rate, and seasonality, especially, is paramount. So you have to
Hmm.
have a very good solution for that.
Great, thank you.
Yeah, you're most welcome. Martha, probably you have something to add here because you're an angel investor yourself.
Yeah, everything you say, Christina, is spot on. Yeah, is this going to make sense in the long term in terms of money? We are a bit different in that we are not a VC, we're angels,
Sure.
and so that 10x and 100x is not something that is always something we look for. However, I do, and I, Christina, I really liked what you said about is this really the market and how much of it can you really get? And if it's really that big, is it because somebody went in there and they tried to get it and then failed? And so there's some kind of major flaws with this market in general. And Kyle, that is something that all investors will look at is really how big this is. I often do not look at when I'm doing a first pass of a company, I don't look so much in the market because everybody is going to say it's a huge market and we're going to get it all. And yet it almost never is. It's that it might be a huge market, but what is the chance that you are going to be able to get it? The one area that I think really is a huge market and that someone is going to get has to do in med tech, where it's really a new device or a new medication or treatment or something like that that really is disruptive in its area.
But the economics of this market is hugely drastically different because usually the investments, initial investments are much higher than in many other industries. So it really does make a lot of difference in terms of how this business model works out finally, ultimately, because the upfront investments are usually higher in this business than in B2B solutions, B2B SaaS, for example, even direct to customer SaaS solutions too.
Well,
Okay.
Kyle, it's the middle of the night for you.
Oh, no. I'm used to it by now,
That's
Martha.
right. Uh, Thanks for your participation. And
No, thank you.
I think
Thank you,
I'm going to
Christina.
stop recording. And let's see.